This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest edition of the AJ Bell Money and Markets podcast. We're going to keep you up to date with all things to do with investing, personal finance, and the stories shaping your money. I'm Dan Coatsworth, and joining me is Laura Suter.
Hi there. So coming up on today's episode, we will look at the latest market movers, but specifically how those tensions in the Middle East are rippling through oil, gold, and travel stocks. We'll also be looking at FedEx and Halfords' latest results and what they tell us about not only the global economy, but also UK consumers.
Now, we were looking at why premium bondholders got a bit of a blow as the prize rate's being cut, and why staying loyal to your savings provider might actually be costing you money.
And we'll talk about the companies putting Bitcoin on the balance sheet, what it means and who's doing it. And I'll delve into a very odd scam story that I came across this week that I know, Dan, you must be very excited to hear about.
In our interview this week, we'll be talking to a couple of fund managers from Evenlode about why their global equity funds have a little less exposure to America than some of their peer group. Now, we've also got a couple of people from Shares Magazine on the show to talk about Rosebank, which is founded by some of the people who used to be at Melrose, the FTSE 100 engineer, and how they're going to talk about how Rosebank has actually pulled off one of AIM's biggest fundraisers in recent history.
So let's start, as ever, by delving into the markets news. Now, the headlines have obviously been filled with all of that talk of tension in the Middle East. We'll leave aside the politics of that for other people, but instead we'll look at how those geopolitical tensions have been impacting markets. So, Dan, if we're looking at it purely through an investment lens, what's been happening this week?
Well, I mean, over the last 7 days, we've seen some really big movements in the oil price. And that's had quite a big impact on investor thinking. Now, what was originally the sort of catalyst for this? That there was the tensions between Iran and Israel led to people thinking, okay, could Iran potentially disrupt global oil supplies by blockading the Strait of Hormuz in retaliation to US strikes on nuclear facilities? So this is significant. So about 20% of global oil and gas flows through this narrow shipping lane in the Gulf. And obviously blocking it would have had a profound impact on the global economy because it would potentially disrupt international trade. It could force up energy prices. It could push up the cost of goods and services worldwide. And it actually could hit some of the world's biggest economies. So like you're thinking China and India and Japan, because they're among the top importers of crude oil that passes through this strait. So we saw markets get very worried that this was on the, potentially going to be on the cards. And we saw, the big rise in oil price. Obviously that pushed up shares in oil producers, but actually it sort of weighed on some other parts of the market, particularly things like travel stocks. I think lots of people just worried that suddenly people would stop traveling to certain parts of the world. Obviously, higher oil prices is very bad news for airlines as well, because it's the cost of flying is one of their biggest costs that they have to suffer. So all this sort of led to a couple of days of sort of a bit of wobbles here and there. But when we had news from the US that they, saying that they'd broker a truce deal between the two, we saw a complete reverse of what was happening. So oil producers on the stock market started to fall. The oil price itself started to ease back. Airlines were rocketing higher up onto, in terms of sort of the rises on the stock market. And then we saw, people sort of switch mode, really. For 1 minute that they were hiding in areas like tobacco and utilities, which are deemed to be defensive sectors. Defensive in terms of doesn't really matter what goes on in the world and the economy. Demand for those sort of industries should sort of take over as normal. So they've taken money off from those sort of places and put it into areas like mining and oil and gas again. So it's quite interesting. Throughout this sort of week. It's, and we've seen plenty of this throughout the year, where you have lots of things going on, and then suddenly the narrative changes. It's just one of those sort of situations where actually, if you're an investor taking a long-term view and you didn't do anything at all, you would have been pretty much unaffected because we've seen a drop and then a complete recovery in a very rapid time. And we've seen that multiple times here. And it just goes to show that, if you're an investor, you really do need to stay cool, stay calm, and it's all about being patient and taking a long-term view and not reacting to everything that happens in the news.
I think it's, like you say, been a very volatile time so far this year, or at least it feels like it. I think, is that maybe because a lot of these investment moves are hitting the headlines, or has it actually been more volatile? But like you say, it's a good reminder to investors that they've got to sometimes ride out these ups and downs of markets and try not to emotionally react to them.
Yeah, I mean, it's definitely, these when you get stuff that's plastered all over the headlines and you can see a clear link to things on the stock market, it's natural to see this volatility, these wild swings up and down. And I think anyone who's been invested for a long time should know that it's not unusual. I just think that it just need that reminder that if you look back over history, it's perfectly normal to see these swings up and down. And I think once you accept that and you realize that, there's lots of uncertainty and sort of the news flow is kind of fluid. Things are constantly changing, particularly at the moment. It is, you just have to sit back and, see through this noise, stay focused. But clearly, if the investment case for companies really does change because of what's going on in the world, and it's clearly something's happened that will change the narrative longer term, not simply just on a short-term basis, then of course one would expect to see people reappraise their portfolios and think, okay, where should I be positioned longer term?
Yeah, definitely. So let's move away from the Middle East turmoil for now and look at some of the specific companies that have been reporting this week and how they have fared. So let's start with FedEx, everyone's favorite, or maybe not so favorite delivery service. They had their results. What did they show?
It's weird because I was watching the film Castaway the other day, which is almost like a sponsored message for FedEx all the way through. Poor Tom Hanks stuck on a sort of a remote island, but he clings on to his FedEx parcel, and at the end he gets it delivered. It sort of gives this impression that no matter what happens, FedEx will get it, deliver this good message to you. But the results have come out for the business. Unfortunately, they're not a sort of heartwarming message as the Castaway film ended on. Earnings were slightly less than forecast. What really troubled the market was that the company basically said, there's just so much uncertainty going on. We can't give you any guidance for the sort of the new financial year. Now, FedEx is kind of a bellwether for the global economy. If you think about it's delivering goods all around the world. So when you get trade war and tariffs and, constant changes back and forth in terms of what's going on for, trade between businesses and countries, it's not surprising that FedEx doesn't feel comfortable that, in terms of just can't say what will happen next. So, I guess you can understand that situation, but you take a step back. Actually, FedEx has been sort of going through uncertainties for about 3 years now. It's kind of suffering from the post-pandemic world. So through the pandemic, the big demand for people to buy goods online. Since then, that sort of market's been cooling off. You've had people like Amazon have basically been really pushing hard to say, if you order something from us, we will try and get it delivered to you even faster than before. And of course, that's put pressure on competitors. So FedEx is sort of realizing it needs to be really efficient in getting stuff delivered. But of course, more recently with the trade stuff, we've had snags in the supply chain. And more people sort of saying, actually, we want to be sourcing goods locally rather than getting them delivered around the world. So poor old FedEx is having to sort of completely reinvent itself. I think one of the most interesting things it's done is actually decide to trim down the size of its sort of air fleet, use more commercial airlines for sort of low priority cargo. So now you get on a jumbo jet, your bags and stuff will be stored in the hold, but there'll be increasingly be a lot more stuff from FedEx there as well. So that makes sense. But I just think there's still still going through sort of this transition period, and investors are slightly nervous about the near term here. And I guess it's completely understandable.
Yeah, definitely. And I think, if we think about the UK consumer, another company that's impacted by that is Halfords in the UK, which I don't know, do you use Halfords for anything, Dan?
Yeah, I do go in from time to time. I mean, I think up until maybe a year or 2 years ago, I used to do quite a lot of cycling, and I was forever going in there because it's my nearest place to get my bike fixed. But I don't particularly go in there as on the motoring side too much. And I think, this is a problem that Halfords is trying to realize, that it's another it was a big winner in the pandemic. Lots of people were buying sort of bike stuff because they were stuck at home during lockdown, that they're out on the bikes. And so it did really well. But after that, the demand just sort of fell off a cliff for cycling stuff. What it's trying to do now is to reposition itself as a sort of an essential motoring services provider. The results have just come out, and actually they're a little bit better than people were expecting. The margins have gone up. Obviously, it's been pushing up prices. It's been trying to find ways to save money in the business. Actually, the cycling stuff is quite good. That's probably helped by sunny weather. Motoring stuff is actually, it seems to be doing okay as well. So, we got a new chief exec joined a couple of months ago. So everything seems to be sort of finally finding its feet. But the one area which seems a bit odd to me is tyres. If you've got a worn down tyre on your car, surely you'd need to replace that pretty immediately. But for many months, Halfords has been talking about people just delaying that purchase, and when they do it, they're actually looking for the cheapest one possible. So it's losing out to cheaper rivals here. So I think overall we're getting there with Halfords. It's a bit of a self-help story, but I guess a bit like FedEx, the journey's not quite complete. But in terms of stock market reaction, investors didn't like FedEx, but they did like Halfords. So I guess, Laura, you must be, I can see you driving up and down weekends in your range of sports cars and stuff. Are you buying your tyres from Halfords?
No. If you bought your tyres from Halfords, would you have to fit them yourself? Or do they have fitters?
I don't know.
Have fitters. I mean, for, like you say, my large fleet of luxury sports cars, I'm not changing the tyres myself. No, I very rarely go into Halfords, even though there is one near my house. I went in recently because I'm buying my daughter a scooter. I save all of the exciting stories for the podcast. And I wanted to go in and see which size was right for her. So we tested them out in store, which is great, but I realized that I could buy it way cheaper from somewhere else online. So I did what I think probably a lot of consumers do and feel guilty for, which is use the actual store to go in and test things out and look at things, but then buy them cheaper elsewhere. I did feel quite guilty doing that because I feel like that's being a bad consumer. But yeah, it is being good because I saved money.
I always find that you go into something like Waterstones, you think, I want to buy a book. I thought, okay, clearly you can look at Amazon and see how much cheaper it is. And I do sense that the staff are just peering over your shoulder going, oh, here we go, another one. Yeah.
Exactly. Definitely not alone. Let's move on to personal finance now. So if you hold premium bonds, there is some not very good news. So NS&I, which is the providers of premium bonds, are cutting the prize fund rate from the current 3.8% down to 3.6% in August. So this is quite a big drop from, we saw a peak in this expected prize fund rate for premium bonds of 4.6% in September 2023. So that is the high point that it hit. And since then, it's been gradually coming down as interest rates have come down. Now, obviously, NS&I responds to the wider savings market. And we've seen the Bank of England cut interest rates. In turn, savings providers have cut interest rates. And so premium bonds don't need to be quite as competitive to keep up with the rest of the market. And I think this is not going to be the last cut that we see for this premium bond rate. As we see more cuts from the Bank of England, we're going to see this rate chopped back down again. But it's now similar levels that it was at 2 years ago, the expected prize fund rate. And if you think about the top easy access account on the market pays 5% interest. That's a fairly decent gap that you've got between 5% from the leading standard cash account, down to 3.6% for that expected price fund rate for premium bonds. So you're sacrificing a lot of guaranteed interest to effectively gamble on the fact that you might win big on premium bonds. It's probably worth explaining what that prize fund rate is on premium bonds. So this is intended to give a comparison with more traditional savings accounts. But it can be a bit misleading for savers. So it's basically worked out on the average return you would get based on having average luck in the prize draw of premium bonds. And clearly no one has average luck. So you have the chance that you might win big. You might win the million, which I think is the lure for lots of people. But the reality is that for every person that wins a million, there are hundreds, if not thousands, that win absolutely nothing. And we did a Freedom of Information request earlier this year that looked at the number of premium bond holders who've won nothing. And it's almost 2/3 of all premium bond holders have not won a prize. So it's a very real possibility, particularly if you have smaller amounts in premium bonds. So the way to think of the accounts is a bit like each pound that you've got in your account is kind of like buying you one ticket to the lottery. So the more you have in your account, the more likely you are to win that big prize. So there's lots of people that have very small amounts in premium bonds, £100, maybe even £500. Their chances of winning or winning big are much reduced compared to the people that have the maximum amount that you can have in premium bonds, which is £50,000. So it's definitely worth considering if you're going to be one of those smaller premium bond holders, whether it is actually the right account for you or whether you're better going for a more traditional savings account.
Yeah, I think I'm probably at the lowest possible you can get. My parents gave me £5 worth of premium bonds when I was a kid. I don't even think you can buy £5 anymore, and I've never won ever. But I kind of view it as, what's the point in taking out £5? It's a small price to have in case I do ever win. I mean, the odds are, I still have a chance.
You have a better chance than if you had no money in there. And £5, you're right, these days, that won't even buy you a pint. So you may as well keep in there. And what a great story that would be if your £5 savings that have presumably been in there for 20 odd years made you a millionaire. That'd be great.
Yeah. Fingers crossed. Yeah. I mean, we also had some stuff out this week, sort of a reminder that loyalty doesn't always pay. We talk about it's really important to shop around for stuff, but we've got some data that says loyalty does not pay, especially in savings. So we've got some figures out from Money Facts that show some of the worst paying savings accounts are the ones that banks offer to long-term customers. So Laura, tell us a bit more about this.
Yeah, I think this is one that lots of us are aware of, but I think maybe it's helpful to hear the figures because I think a lot of people are guilty of just leaving their savings either in an old savings account that they haven't looked at for years, where the interest rate has probably plummeted to next to nothing, or they leave their money in a current account which isn't earning any interest. And what Money Facts found is that the biggest high street banks, so those ones who have the brand names that we've all heard of and have branches on the high street, although in dwindling number, they pay an average of 1.56% across all of their easy access accounts. And that is the average. So there's going to be lots of accounts there that are earning way less or nothing. And then if we compare that, the average easy access savings rate across the whole market is 2.72%. So still, not amazing when we think about where the Bank of England base rate is, but much higher for the whole market than for those high street banks. So if your savings are sitting with a high street bank or a really well-known name, definitely check out whether you could get a better rate elsewhere. I thought I would do a quick run through of rates because I think we quite often talk about, could you get a better rate? Have you got an old account? But it's really useful to have that ballpark or that benchmark of what you could be getting on your savings. And it might help provide a bit of a jolt to some people that they could be getting much more on their money. So my caveat for this is these are the top rates. The rates do change and they change very regularly. So this is accurate to when we recorded, which is the 25th of June. And it's based on Money Saving Expert data. And It's intended to just give you a quick idea or a sense check. Some of these have a bit of caveats to them, so you obviously need to check it out for yourself. But I thought it would be good to have a ballpark. So let's start with cash ISAs first. So the top easy access account that you can get at the moment in cash ISA is from Plum, and it pays 4.92%. So I think that's pretty decent. You're just shy of 5% there for a cash ISA, which is protecting your money from tax. It does have a newbie bonus on it, and quite a lot of these top deals will have a kind of 12-month bonus or a bonus for new customers. So you definitely need to make a note of when that ends, because you know your rate will drop at that point. It also has another little tricksy element where if you make more than 3 withdrawals a year, then the rate will drop. So it's little things like that you need to look out for and think about how you plan to use that money, how many times you need to access it, as to whether those kind of accounts are right for you. If you wanted a more well-known brand, then you could go for Skipton Building Society. They have the top rate for easy access cash ISA from a more well-known provider, and that is 4.1%. So you can see the sacrifice that you're making in interest there to go with a kind of more well-known brand that maybe has a branch that you might want to go into. And then if we get to fixed rate accounts, 1 year fix is from Synergy Bank, and that is 4.35%. And the top 2 year fixed rate is also from Synergy Bank of 4.25%. So those kind of give you a bit of a ballpark for the cash ISA market. I should also give a small shout out here to the Doddle ISA. So this is an investment ISA, but it pays interest on the cash that's sitting in your account while you invest. That pays 4.32% interest on any cash sitting in that account. But let's switch to non-ISA accounts, because some people may have already used their £20,000 limit for this year, either on their investment ISA or other ISAs. So if you want a non-ISA account, if you don't mind opening a new current account first, Chase is the top offer. So this is a US bank that's moved into the UK in a big way over the past few years. It's app-only banking, and it's very quick to set up an account. And that will pay you 5%. So you need to open the current account to be able to access the savings account. But for new customers, you can get 5% paid, which is a very great deal. It has a bonus rate that lasts for a year and then it drops. So another one where you need to make a little note in your calendar of when that rate is going to drop to make sure that you're switching at that point. If you want a better known brand, then Santander owned Kahoot pays 4.55% on its easy access account. And then once again, for fixed rate, Synergy Bank is coming up top. So it has a rate of 4.55% for a 1 year fix, or 4.45% for a 2 year fix. So hopefully that gives a bit of a ballpark and maybe a bit of a jolt if you're sitting there thinking, actually, my savings are earning 1% and I could earn a decent amount more by shifting.
Kahoot, blimey. I there's a name from the past. I remember when that launched. I thought they'd phased that brand out, but clearly
I
not.
haven't heard of it for a while, but it is still going and offering some top rates.
Because just as we were recording this, there was I noticed that there was a new account from Zopa called Biscuit. It looks like a financial app that rewards people for good financial behavior. So it seems to have like perks like bonus interest and prize draws for regular savers. So I guess maybe one to sort of keep an eye on. It's a new area for Zopa. It hasn't really done that sort of that part of the financial services before. But maybe one to keep your eye on that.
Yeah, I think it's got like a very attractive intro offer of, I think, something around 7% for a savings account from them. I do slightly resent the Biscuit name. I think it feels like they probably paid a lot of money for a branding agency to come up with that, but I'm not a big fan.
Well, better than Kahoot, I guess.
Yeah, to be fair, maybe lots of them aren't great. Let's switch it up now. Let's talk crypto. Everyone's favorite topic. So, Dan, you've been diving into a very interesting trend that's been going around of companies essentially buying up Bitcoin, putting it on their balance sheets, and seeing some pretty meteoric rises to their share prices as a result.
Yeah, this is sort of a trend which seems to be unfolding quite rapidly. if you cast your mind back about, I don't know, two years ago, literally we had this, artificial intelligence was really taking off. And then suddenly you saw a load of really small companies go, crikey, if we put artificial intelligence or AI in our sort of press release or stock market announcement, it seems to make our share price go crazy. I feel like we're on the cusp of this again, and it's Bitcoin treasury company, not very catchy, but it's sort of like cool.
Does it?
Yeah, no, I mean, it feels like these are three. The advisors to these companies are going like, here, put these 3 magic words in your announcement, and everyone will sit up and take notice. So there's a company called MicroStrategy, which is listed in America, but really popular with UK retail investors over the last couple of years. If you think about Bitcoin, you can't hold Bitcoin directly in an ISA or a pension. But there are some companies like MicroStrategy which effectively become a proxy for the Bitcoin price. So investors have been buying them in this sort of the tax efficient investment accounts, and essentially, if Bitcoin price went up, there seems to be sort of really close correlation with what's been happening with the MicroStrategy price. Actually, MicroStrategy has been going up even higher. Of course, it works the opposite way when the sort of the crypto price falls, shares in a company like MicroStrategy falls as well, again potentially by an even greater amount. So what we've got now is a load of smaller companies essentially doing exactly what MicroStrategy has been doing, buying Bitcoin and saying we're going to hold it as a reserve. Now, it's worth pointing out that MicroStrategy calls itself a business intelligence firm. Laura and I were having a big chuckle before we recorded this podcast, trying to work out what on earth that meant. Went to his website.
I'm not sure I'm any the wiser, to be honest.
No, something to do with data analytics. But suffice to say, I don't think the average person who invests in MicroStrategy would say it's a business intelligence firm. They're going, oh, it's that Bitcoin company. And I think that we've got this situation now. So loads of these smaller companies that are coming out saying that they're a Bitcoin treasury company actually do other stuff. Some, the one that sort of perhaps is catching everyone's eye is called Smarter Web Company. It does something to do with web design. Came onto markets earlier this year, valued just under £4 million. Well, last week its valuation had hit £1 billion.
What?
And all it's been doing is continuously raising new money and using that to buy Bitcoin. That is simply it. So £1 billion valuation. If you went and sold all of its Bitcoin in the market today at the market price, you'd only get about £42 million for it. So where's this? What's happening with this gap in the valuation? The market seems to be, basically saying this is the best thing since sliced bread. But you have to ask, well, what's justifying this valuation? So I counted about 10 or so small cap companies in the past week doing the same thing. They're coming on the market saying we're going to buy Bitcoin, and then the share prices. One of them was almost 100% just on that announcement. And also, I basically found my favorite press release or favorite stock market announcement that I've ever seen ever in my history of writing about the markets. And it's from a company called Panther Metals. It's a mining exploration company. It's looking for zinc deposits in Canada. So it came out with a press release saying, we have purchased one Bitcoin. That is a single Bitcoin. And I got to quote what's in this press release. It basically says, Panther is redefining what a modern resources company can be. In an era defined by volatility and transformation, our company stands uniquely positioned, not only as a resource-backed business with tangible physical assets, but now also as a strategic bridge into Bitcoin and the digital financial ecosystem.
Based on buying one Bitcoin.
Yep. So it's bought one Bitcoin and now it's completely changed. So I think anyone who originally was looking at that stock saying, okay, I'm looking for opportunities in the mining sector. Well, guess what? It's now basically saying everything's about Bitcoin. It's not the only one. There's one called Bluebird Mining Ventures looking for gold in Asia. So it's been it's arranged a borrowing facility. It's going to then buy Bitcoin with this borrowed money. It now says it's a physical gold and a digital gold investor. So, I mean, all of this sounds like companies are jumping on a bandwagon. And I have to say, you've got to be really careful. If you think about when you go and pick an investment, you would look at a company and say, okay, I really need to understand what it does. I want to look at, what sort of contracts it's got, what's it trying to do, what assets does it own. You look at different ways to value it, and you try and get a sense of, is it a fair valuation or not? Well, these companies now are saying they're Bitcoin treasury companies, and it's like, what on earth are you trying to be valuing them on? I guess I confess I still don't get my head around what on earth it is that is exciting people about cryptocurrencies, and I know that perhaps we're well overdue. We should get someone on who is pro Bitcoin. Well, I'd love to hear the other side of the argument, but I don't get it, and so I'm still sort of wondering why their share price is sort of going crazy on this. And so I would say just be really careful here. If you're reading about these things on social media, everyone's getting excited, or simply because the share prices are going wild, does not mean to say that they are really good investments. So you need to think, why? What is it? Am I buying here? What am I owning? So just a big, massive risk warning if this sort of trend, comes across your daily research, or you might start to read about it.
Yeah, because I think even if you are the biggest fan of Bitcoin, you're the biggest proponent of it, you believe it's the future, I still can't see the logic of buying shares in a company that's valued at $1 billion when it only holds, 42 million worth of Bitcoin, because you've banked in a lot of future Bitcoin growth before you can get to your valuation. And so I think it's not just a question of, are you pro or anti Bitcoin or ambivalent about it? It's also about, like you say, going back to the fundamentals of how you pick investments and basing it on their underlying valuations and their underlying assets. So it's kind of a story that's pegged to Bitcoin, but it's not necessarily just about the value of Bitcoin, is it?
Yeah, exactly. So, I think I think this is going to really be a hot topic in the coming weeks, particularly if we, given the pace of the stuff we've seen over the last 7-10 days in terms of small caps. Unfortunately, we live in a world where everyone seems to copy each other in terms of smaller companies going, as soon as they realize that they can get publicity for this sort of thing, it seems inevitable more are going to be jumping on this bandwagon, and it's not necessarily a good thing.
Let's switch tack now. So bring on our first interview. So Dan has been catching up with the fund managers at Evenlode Investments to talk about why they have relative low exposure to the US in comparison to some of their competitors, and why they tend to avoid the obvious targets like the big tech names in their global equity strategy. So let's take a listen to Chris Elliott and James Nodler from Evenlode's global equity team.
Well, I'm very pleased to be joined by two fund managers from Evenlode. So Chris Elliott and James Nodler, thank you very much for joining us on today's podcast.
No problem. Yeah, happy to be here.
Great, thanks you very much. So I wanted to talk to you both about investing in the US. So you're both involved in global equity fund products, but actually, relative to perhaps what you might expect from a global funds, you don't have as big exposure to the US as one might think. So I don't know whether, is there sort of a decision across the whole of Evenlode, is all your global strategies, or is it just simply where you're seeing opportunities at the moment? They just, most of them don't happen to be in America, or?
So we're very much bottom-up investors. So we're not making a call at all on the sort of long-term prospects, either for the US or for other countries. It really is a sort of function of where we're seeing the best value. Now, I know you say that we're slightly underweight in comparison to other global funds, and most notably the benchmark. I would very much note that the benchmark has been driven up in terms of its US listing over the past year or so by sort of very narrow leadership of a very small group of US companies that perform very strongly. Now, we're very much valuation aware, so we are going to sort of find the opportunities that we think are best wherever they are in the world.
Okay, so I mean, what sort of stuff are you invested in America? So you're not, as far as I understand, you're not sort of loading up on all these sort of AI style fast growth tech stocks. Is a bit more or broader than that.
Yeah, so I think the way I would look at a lot of our exposure is we may not have the companies which are the primary beneficiaries of AI, so the sort of Nvidias of the world. But generally, the application of that technology will greatly benefit a lot of the companies that we do invest in. And that's really because they have two key ingredients. So they have very much proprietary data sources, so some form of data that they have that is incredibly hard for other people to replicate. But also they have an incredibly deep understanding of their clients' workflow. So if you take, for example, a company like MasterCard, which obviously has huge amounts of payments data, that allows it to generate other products such as fraud prevention services. And by really understanding how payment flows look globally, they can then integrate that into different payment mechanisms, different flows, and use that to sort of drive additional value for their clients.
Okay, I mean, Mastercard is also a very interesting one. On one hand, it's obviously give fascinating insight into how people are spending money, but this is a global business as well, isn't it? So it's, I don't know, does it matter where these companies, a company like that, generates the source of its income, or this sort of geographic diversification actually must be a plus from an investment perspective?
Sure, Dan, maybe I'll take this one. I think that's an interesting perspective because while we've been talking about the weighting of the company by the domicile of listing, the reality is that if you look at the sources of revenue for the companies within the portfolio on a weighted basis, they're very similar to the benchmark. So roughly half of portfolio revenue coming from the United States, half from the rest of the world. I think that's probably the way we would tend to view these things. If we were talking about being overweight a certain geography, we would tend to see that as being, very exposed to that geography's fundamental economics, if you see what I mean, as opposed to the domicile of listing. So on a look-through basis, that's how we think about these things. And then if you talk about MasterCard, that's a business that's about roughly a third in the United States. I think it's a good example of the kind of company we like because it's one with a very portable competitive advantage. So obviously it was seeded in America by a consortium of banks, but that critical mass of merchants and issuers, and so the banks who have relationships with individual people who have the cards and the merchants who accept the cards, has proved to be very, very portable globally. And now actually MasterCard are getting into China, which was always seen as the final frontier, which was going to be off limits to Western card issuers. So yes, I think going back to your question, diversification is helpful. We tend to look at it ultimately as where is revenue coming from, where are earnings coming from, and that's more important to us than domicile. And then alluding to Chris's earlier point, the final thing we're building portfolios against, and this is to your point about how the Evenlode global funds look, the single most important thing in our eyes is the durability of their competitive advantage. How long can they keep making the really good profits they're making? And what we found is that certain companies tend to be more fertile hunting grounds for that kind of competitive advantage. And companies where there's a network effect, where every incremental user makes the product better for everybody, are generally speaking the most attractive ones. And we found that there's no real monopoly on domicile of listing for those. So does that give you a sense, maybe another perspective of the way the portfolio looks versus peers and benchmark?
So if you're looking for companies with durable earnings, but yet you pay close attention to valuation, do you not find that if you see a good quality company, is the market not sort of price that quite highly? So you actually have to you pay a premium rating, but would you be happy to do so in that situation? Because if you think it will give you access to a company where you'd be really comfortable about earnings current situation and also potential going forward.
Yeah, and that's question is spot on, and that's where we spend most of our effort. You're right, like typically the market does sniff out a company with better earnings duration, and it's, not rocket science that. We think, and our experience has been empirically if you look at the history of our strategies, that you can find quite a lot of divergence, even within a pool of companies with similar premium ratings and premium growth. And it comes down to going down a layer or several layers and isolating the factors which will continue that growth and that earnings power. And I'll give you an example quickly before I sign off. A few years ago, for instance, PayPal was the leading mechanism by which you could get your cards accepted in e-commerce. And that was really important because clearly e-commerce is growing at many times the rate of the broader economy. And it became a very valuable stock as a result of that. And we looked at that in tandem, obviously, with a MasterCard and a Visa. And our work suggested that PayPal had become, in the years since it had stopped being just a exclusive program for eBay merchants, it had become very reliant on people funding their wallets using your classic credit and debit cards. And that allowed us to differentiate the durability of the business advantage, because essentially they were a layer down from the apex of the payment system, which is the networks, Visa and MasterCard. And that, when you have that kind of thesis and you can back it up with data, I think that's where we get more comfort playing, to your point, a higher earnings multiple. But while the earnings multiple is higher, our view is it probably should be empirically, and this is the case if you look at a lot of companies over the years, their earnings multiples could be continually high, but they should have been even higher.
Yeah,
as in they're priced relative to the durability of their earnings growth.
Yeah, I'm just to add to that, is exactly spot on. But I mean, we do find that you can find these businesses at reasonable valuations. If you look at the free cash flow yield, which is one of the measures we use to sort of determine the overall value of the portfolio, we're at a sort of higher free cash flow yield relative to the underlying benchmark, which is perhaps surprising because these businesses are, as James says, more durable. They've got stronger competitive advantages. They're less cyclical than the market. But also you're seeing the cash flow growth at a higher rate. So there are still opportunities out there. You just have to do quite a lot of digging to find them.
Yeah. I mean, what have you got anything in your portfolios that is, US listed, but actually might be a bit more reliant on the US economy for earnings at all?
We do have some more domestically driven businesses, yes. Just to cite a couple of examples, Jack Henry, which is a core banking provider, which is almost entirely domestic. Another would be Verisk, which is an aggregator of insurance information, which is largely, but not exclusively, US. A few other examples, Visa is much more US skewed than MasterCard, for instance. So we do have some more domestic US plays, but I think the reality there is that the US is a vast market and fairly homogenous compared to, say, the European Union, with much higher GDP per capita compared to, say, China. So while it's a single market, it's a very, very big one. So you can get a degree of comfort being invested in a domestic player there.
Yeah, I think the other one I would probably add that is sort of more sensitive to the economic environment. We have exposure to the derivatives exchanges, which have fantastic network effects, basically in how they allow participants to effectively trade with lower margin requirements. So less capital needing to be deposited with the exchange. Now, those are businesses which obviously do respond to different changes in rates, but they tend to have more revenue generated when the markets are more volatile. So provide a really positive hedge.
Yeah. I mean, I think that it feels like certain investors are starting to lose a bit of interest in the US. The US stock market has certainly been one of the laggards into performance-wise this year. But is that sort of thrown up any opportunities, or actually the market's not sort of derated enough to warrant things that perhaps might have looked expensive or to you in the past, but there's still, we're not in bargain territory yet, surely, at the moment?
No, I mean, the US market was incredibly strong in the second half of last year, so it's always worth sort of looking back at the S&P 500 share price chart and seeing where you were last year, because it's not got as cheap as perhaps people think. We have, though, made some changes. We did add New York Times as a recent addition to the portfolio. So it's a fantastic business. We're seeing increased consolidation of the US news media. It's now about 5% of all journalists in the US work for the New York Times, which is, I think, quite a stunning number, but it shows the level of consolidation in the market. They've been able to grow subscriber numbers in sort of comfortable double-digit levels over the last few years. And actually, a number of those are still on sort of introductory deals. And as you see those move on from introductory deals onto full price deals, onto bundles, as they add in the sports, the puzzles, the cookery, what have you, there's a very, very solid pathway for growth there.
Is there not a risk with sort of a newspaper company that reliant on advertising as a key source of income, that actually, if we get, there's been lots of sort of downgrades to what people think the US economy will do near term? Is that, that must be negative for companies and thinking, oh, maybe we don't want to spend as much on promotions. And so a newspaper owner will surely lose out in that situation.
Sure. No, that's a very valid point. So the thing is with the New York Times is that the business model has changed quite substantially over 25 years ago. 25 years ago, by far the bulk of the business was, to your point, advertising revenue. Roughly 70% plus of the business's revenue is now from subscriptions. Over 80% is non-advertising. This is really important because those are less cyclical revenue streams. And we've seen this happen essentially because in the old days, you would have a geographic monopoly. If you want to buy an affluent audience in Atlanta or, Seattle or New York, you would have to buy the local advertising campaign with the local daily. That's no longer the case. So they've been forced to move to more of a subscription model. And that has had the side effect of making it very hard to maintain that many quality dailies in the country. And actually, most business models which are based on news content funded by advertising have been under serious stress if you looked at, say, BuzzFeed or Huffington Post. But yes, it's a higher margin revenue stream than subscription for sure. So we are conscious of that, and that's reflected in our position sizing and our expectations around risk. That being said, when you have a business with a very powerful structural growth driver, and there is one that people, empirically, there is a body of people who are willing to pay up for their news and it's growing, often that will cut against any kind of cyclical movement. And that's not a bad situation to be in.
Excellent. Well, Chris and James, thank you ever so much for coming on the podcast. It's been brilliant to talk to you about what you're doing on the US side of things.
That was Chris Elliott and James Nodler from Evenlode's global equity team. Back to the UK now. So Ian Conway and Tom Sieber from Shares Magazine are going to be discussing engineering company Melrose, what the company does today, its history, and how some of its former executives are looking to repeat their previous strategy with their new vehicle called Rosebank, which just raised £1 billion in AIM's biggest ever fundraise.
So we're here today to talk about Melrose Industries. Today, it's a FTSE 100 aerospace engineering business, but there's a fair amount of backstory to cover with Melrose. And some of those involved in that backstory are launching a venture of their own, which we'll talk about later. To kick things off, though, Ian, could you explain in a bit more detail what the Melrose business looks like today?
Yes, Tom. It has two divisions: engines, which generates about £1.5 billion of revenue a year, and structures, which generates about £2 billion pounds a year of revenue. I mean, it is one of the leading aerospace companies in the world. The company estimates something like 100,000 flights every day use equipment that they've manufactured. Now that's in the commercial aerospace market, your so Boeings and your Airbuses, but they also supply parts to the defense sector. So they supply parts for the Gripen, Saab Gripen fighter and the F-35. But that's still only a small bit of their business. It's actually less than 30% of their business.
Yeah, and I mean, obviously, this used to be GKN Aerospace, it used to be GKN as a whole, which also included an automotive engineering business, which has demerged and is now known as Dowlais and has a separate listing on the stock market. So Melrose bought GKN some years back, and it's kind of pivoted away from what it used to be. But if if we go into the sort of history of it now, the strategy behind Melrose before it took over GKN and then pivoted to being purely an aerospace business along the lines you just described was quite straightforward, I suppose, on the face of it. So what they did was buy poorly managed, but what they perceived as good quality manufacturing businesses, which they felt were suffering from a lack of investment. Once they bought them, they looked to drive operational improvements. They looked to improve the level of cash generation. And then once they'd done that, they looked to sell the company on for a healthy profit. And they had a typical time frame, maybe from buying to selling a business of 3 to 5 years, but they did have some flexibility there. They didn't kind of stick to that because obviously, sometimes it would be optimal to sell. And I guess to kind of put it in a nutshell, and certainly this is Melrose's tagline for its approach at the time, they had a buy, improve, sell model. Now, they sometimes got compared to private equity, but that was probably a little bit unfair given, this wasn't about stripping out costs and kind of trying to get as much cash as possible out of the business. It was about investing in the business and genuinely improving it. And it was a pretty successful model. They quite often, they very consistently, in fact, managed to drive a kind of a real improvement in the margin performance of the businesses they took over. And it really paid off for shareholders too. So looking back in 2021, so kind of after the GKN acquisition had been made, but before, they fully pivoted away from what they had been doing, it had generated a 19% annualized return from 2003 up until 2021. And 2003 is when it listed on the stock market. And that's versus around 7.5% annualized return for the FTSE All Share over the same time frame. And by Melrose's own reckoning, if you'd invested £1 in the original fundraising back in 2003, then if you'd kind of held it and reinvested all of your dividends, you would have been you would have had a holding worth £15. So clearly this was a really, really successful strategy. And what's interesting, I think, is that there are some former executives at Melrose that are now involved in a new venture, Rosebank. So Ian, could you tell us a bit about that one?
Yes, Tom. I mean, as you say, Melrose was phenomenally successful, and fund managers have a real soft spot for it. So there was a great deal of excitement when last year a new company cropped up called Rosebank, run by Simon Peckham, who used to be the chief executive of Melrose and was one of the co-founders, and Christopher Miller, who was one of the other co-founders. And these guys have, they listed on AIM last year. They raised £50 million. That was 20 million shares at £2.50. This was in July. The first day of trading, the shares jumped 74%. And that was institutions trying to get in on, obviously, hopes that they're going to repeat the process. They've since raised $1.4 billion to buy a US company called ECI, Electronic Components International. They reckon that they can get the EBITDA margin up from 13% to 18% with some clever restructuring and investment in the business. And the shares went from 50 foot. What were they? So they came at £2.50. They were trading at £6. They announced they were going to do this fundraising. Shares were suspended. There is 1.4 billion at £3 a share, and the shares now trading at £3.40. So, it has been already. They've already demonstrated that they're going to go down the same path. And interestingly, not only are the founders involved, but the current CEO of Melrose, Justin Dowley, is also the CEO of Rosebank and the CEO of Scottish Mortgage. Throw that in there.
Yeah, that's interesting. Yeah, I mean, I think that was a record fundraise on AIM, so it demonstrated the amount of appetite there is for this attempt to repeat the success that Melrose enjoyed. I do remember that a few years ago there was a somewhat less successful attempt to emulate Melrose. Some former Melrose executives, not as senior as the guys that are involved in Rosebank, they were involved in one of the businesses that Melrose owns. They set up something called Sterling Industries, which I'm afraid to say kind of had quite a short time on the stock market and has delisted and put itself into liquidation. But I think there's definitely, potential for Rosebank to be a lot more successful than that. And potentially, I think, obviously they've raised this money on AIM, but at some point they might move to the main market.
Sure. And they've actually, there's another firm which has joined AIM, but this Rosebank has sort of encouraged another firm to join the success, because in December, a company called Amcomri listed on AIM as well. AMCO is the ticker. They raised £12 million at 55p. Shares are already £1. So there's a lot of anticipation. They did a couple of deals last year. They announced in their 2024 results that revenues were up over 20%. EBITDA was up over 30%. And like Rosebank, like the Melrose of old, their motto is buy, improve, sell. So there's a good deal of anticipation that these guys can repeat the trip. They said trading year to date has been in line. So that's another one to watch.
Yeah, really interesting. And, I think obviously Melrose Industries is now a very sort of distinct thing from what it used to be. But it is interesting for investors, I guess, that there are these two names that are looking to emulate what they did before. And, if they can be anywhere near as successful as the original incarnation of Melrose, then they'll make their shareholders very, very happy indeed.
We wrote up Melrose a few months ago, and one of the suggestions that we've been hearing from investors was because obviously Melrose still has these associations of buy, improve, sell. Now it is a pure play aerospace business. Just call yourself GKN Aerospace.
Yeah, I think that would be a sensible.
Yeah, with all the excitement around defence stocks, it would probably get a re-rating. They actually put out some very, very punchy 2029 targets. And there's been a lot of earnings upgrades for Melrose as well.
So that was Ian and Tom from Shares Magazine talking about Melrose and Rosebank. So before we go, Laura, I know you promised at the start you're going to talk about some scams this week. So tell us more.
Yeah, so as you can imagine, in our job, we get a lot of weird and wonderful press releases come into our inbox each week. And we had one this week about a person who had been scamming people being convicted. So far, not that unusual. But for some reason, I decided to read through this one. And I was amazed by the way that they carried out this scam. And I just thought it was interesting. So it is a Chinese student who has been sentenced to over a year in prison in London Crown Court for operating an SMS blaster. Do you know what one of those is, Dan?
God. Well, it sounds like someone who's like firing off 1 million text messages in a second.
So that is exactly how it happens. So there's a device hidden in his car which impersonates a mobile phone mast and then uses that to send fraudulent text messages that appeared to be from trusted organizations to people in the vicinity to steal their personal information. Wow. I just think when we talk about scams and we talk about new scams emerging, you don't think of someone driving around central London with the technology in their car, enabling it to blast out text messages to people that it passed. It just feels quite mad to me. And so it was a kind of a good cross effect of like the police working with mobile phone networks, Ofcom and the National Cybersecurity Centre to try and target this person. And obviously it's resulted in a conviction. But it just feels crazy to me how these scams are spread.
Yeah, I mean, I frustratingly, I'm getting so many on my personal email. And it's like, the email provider just siphon them off into like spam folder, but you go in there and you see it every day. It's like 2, 3, 4 every day. And I think, come on. And you block them. And and he goes something else. But I can see people who aren't, just casually looking at those text messages or emails, or even now WhatsApp messages, just sort of saying, okay, well, you have to think every single message is real or is it not? And it's like it's frustrating, and it does look like it can only get worse, which means I guess you as an individual really need to be on the ball, and make sure you're not sharing your personal details. And you particularly don't want to share financial details with anyone, really.
Exactly.
So that's all from us this week on the AJ Bell Money Markets podcast. So next week, Tom Sieber is going to talk to one of North America's oldest investment trusts, which is Canadian General Investments. So portfolio manager Greg Eckel is going to talk about how he's responded to the Donald Trump administration in the US and what that really means and the prospects for Canadian stocks.
And in the meantime, you can subscribe to us wherever you get your podcasts so you don't miss an episode. And don't forget to leave us a review if you found this interesting, insightful, entertaining, all of the above. And until then, we will see you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.